Okay, last time when we met, we spoke about trading systems. This was on Monday. Today, what we're going to talk about is what makes those systems basically a little more complete than just pure indicators and opening positions. So once we're done with this, what we're gonna go and do is we will go inside the markets and try and find a couple of trades. So I just want to talk about a couple of small points. And again, I know I might get boring to some people about speaking about risk management again, but believe me, I'm never going to stop speaking about risk management. And the reason I'm telling you this, why I'm going to continue speaking about risk management for the rest of my life, is because it's so important. I just can't explain the importance of it to people. You know, recently I spoke to a friend of mine, and he was telling me about a trader that traded his funds, and they had a big number, a really big number there. And once I learned that his trader, and if you could see me right now, I'm making little bunny ears with my hands, saying trader, was never trading with a stop loss. Obviously, just like I'm pitching you why you should be trading with stop losses, why you should follow risk management, and I'm pretty sure it makes sense, excellent sense to all of you to use risk management. If you don't, tell me, and then we're going to sit down, and then I'm going to do my best to explain it to you even more, so you understand the value of using good risk management. So, long story short, this guy was using a trading system that he says is amazing, and it's been making tons of money. I've heard this before many times, and I'm sure many people have heard that too before. But what that system was lacking is risk management. The fact that it did not have a stop loss means there is no risk management. You cannot have risk management in forex trading, stock trading, or any kind of trading or investing without some kind of protection. For you to say that you're going to close the positions yourself is, well, you know, there is a massive risk with that, because that means you have to be in front of the computer all the time. One. So you're messing with your time. You're going to get bored. You're going to make mistakes. You're going to get into more positions, because the more you look at this market, the more you want to open positions. Point number two, your power can die out. You know, there could be an earthquake. Anything could happen. So the market could move so fast that there would not be any positions for you to close. There would not be any possibility for you to close your actual entry. So let me explain you what I mean by this. In the financial markets, if I'm buying right now, let's say I start buying USD JPY, and if preferably selling, but let's say if I'm selling USD JPY, that means that I have to take these contracts from somebody else. We live in such a quick and fast-paced world right now that this happens in milliseconds. In fact, right here, you can see the latencies of this, and that's 40 milliseconds one way, 45 the other way. So to send and receive is 85 milliseconds, not even 1 second. Once I press this, not even 1 second, and my order is already executed, and every bank and whoever else is receiving the information receives the information that has actually happened. But when markets are moving at rapid paces, for example, the best thing I can show you right now would be the Swiss franc. What happened last year? I'm sure many of you remember. Let's go right here. Let's go to the daily. This. So this thing right here. This big, huge move. And as you see, this is a daily chart, so this is 1 day. If you were to be so unlucky and have a buy position up here, there is no way in hell you would get out of that position by simply clicking close. There is no way. Believe me, you would click and all you would see is a circle going around. This would become at least a couple of hundred, maybe 1,000 due to this. Now why? Why would that be happen? Not because there is so much amount of information going up and down. The only reason this would happen is because nobody would be buying. Every big player in the industry took this down. There was no one that wanted to buy your or take on your buy position and give you their sell, because once you close a position, go to the history. Oh, wrong account. Anyway, once you go inside the history of an account, you'll basically be able to see. Just a second, I'll just find the one with more relevant information. Okay, so if I press on the information button, you will see that we are actually closing, and then we're actually, what is this? 1 second. Let me just find it real quick. So this was a what? A sell, a buy? This was a sell. So once we're closing it, it's becoming a buy. You see? Opening direction, sell. Closing direction, buy. Okay? So basically what I'm telling you in simple terms is, and going back to that story, is pretty simple. This person was not using a stop loss. The reason, and as soon as I showed this to my friend, he kind of lost it, because this whole time he was preaching me how this guy is amazing, and how, well, just the normal sense, because this guy sold him the idea that he's good, and he sold him the reasons why he shouldn't use a stop loss. But then when I looked at his history, and I showed him that his biggest loss was about $600 something, but his biggest win was just under $200. In the long term, even if he had $10 million in his account, this guy would bust it. Why? Because he's taking big losses and small profits. He can have a 99.9 win ratio, but eventually he will be bust. And the reason is big losses, small profits. And we're going to come to that. Right now, I want to talk to you about consistency and its importance in the financial markets. Consistency is a vital part of any kind of trading system. In fact, it is important to any kind of job. If you are not consistent, then you're wasting your time. Let's talk about business. In business, if you do, let's say you're working for somebody else, okay, you're employed, and you work in sales, and you sell 100 contracts in 1 month, and the next month you sell 2. Then the next month you sell 50, and then you sell 2. And then you sell 100, and then you sell 2. That's not consistent. It's consistent on a 2-month basis, but you understand you're making less than more, and that's not consistent, and that doesn't really work. I can give you better examples, but I don't want to waste too much time. What I'm trying to explain to you is that if you're not consistent, things need to change, but they need to change inside your mind and not in what you do exactly. Maybe if you're taking on massive losses and small profits, well, then a lot of things have to change. Following trading rules, for example, you need to be consistent in that. Following your system and the way you open and enter positions is where you need to be consistent. These are the most important things you can do after you learn how to play the game and start playing the game. You have to be consistent in risk management. So when we come to risk management, I just want to pop into it real quick, just for you guys to, refresh your mind with risk management, and for me to really piss you off a little bit more. So you can grow. Let's put it in the most simple terms I can show you. You can grow your account by thousands of percent, right? You can do that very easily. So you can grow your account by, an infinity amount. But how much can you always lose? You can always lose just 100%. This is why risk management is so important. Because I can grow my account by 10,000% in one day, and then the next day grow it by another 1,000%, and the third day I grow it by 500 million%. But when all of that is done, I just have 100%. And I can only risk specific percentages. I don't have 10,000% in my account. I have 100%. And this is where most people make the mistake. What they do is they trade, for example, okay, and they start with, let's say, $1,000, and they trade okay, and they're doing great, and they turn that 1,000 into 10,000. As soon as that money changes, they look at the money. They don't look at the percentage, and they start trading differently. A bit more aggressive, higher positions, more sweat, bigger losses. They're looking at the number. They're looking at the dollar value of it. And excuse my language, that's where most people fuck up. And the reason I'm swearing again is just to get my point across. Percentage gain and loss is what counts the most. Okay? Like I said, you can grow your account by 10,000%, but you will always have just 100. There is an expression in this market that goes like this. There are old traders and there are bold traders, but there are no old, bold traders. The moral is that the traders that don't use stops go broke. Everyone here must use stops. Everyone. If you want to be alive in the market, if you want to be here and make money and be happy and don't get sick from stress and things like this, and don't lose your family and your house and everything you have and all of your time, then you just have to really, really follow risk management. I mean, if I could come to all of your houses, I would literally stencil risk management on front of your station. I mean, if I wouldn't want to, I don't want to get blocked by people, so I would send you emails every day. Use risk management. Scream at you, you know. I just buy you a parrot that shouts at you to use risk management because it's so important. Now, the key to risk management is basically never putting yourself in a position where you cannot live to fight another day. I've seen many people. Good. I will, Peter. I will keep yelling. Believe me. As you guys can see, I do have more energy in me. When I got sick, that really put a massive dent in my enthusiasm and motivation and things like this. But I always had it here. I kept going. I kept shooting, and I haven't even lost anything. I've just lost a little bit of time, but I learned a lot from those things. So what I'm trying to tell you is this. The key to risk management is never putting yourself in a position where you cannot live to fight another day. Living to fight another day is, well, why we're here. You know, we all risk. We should take risks. But there are smart risks, and then there are stupid risks. And many people, and believe me, you've all taken stupid risks, and so was I. And so I took so many stupid risks in my time here. But it's because I learned from those risks. And I will speak about this pretty soon. If I didn't take those risks, I'd probably not, well, I most definitely would not be sitting in this chair talking to you right now. Richard says that he can already see the parrot screaming behind him when he opens a trade. Use risk management! And yes, you should. Michael, good to see you here. Good to see you here. Yes, thank you. I am here. I'm here to fight. There is a recording of the other session out. I'm going to get the guys to mass mail it to everyone. Again, I know the sessions are sometimes a little long. I know people would prefer to have shorter sessions, but I do talk about quite a few things, and I think it's, well, this is how I work. Anyway. Now, I'm done with risk management for now. I'm going to go into goals. I don't speak to you guys about goals too much. The most simplest question I can ask you, I don't want you to answer it, but it's a question that you should all ask yourself. And that's, why am I investing? Why are you investing? It's okay if you have many answers to this question. But there is a massive problem if you have no answers to give right away. Like when I ask you, why are you investing? You need to know exactly why the hell you're here. Because if you don't, there's a big problem. That's exactly like driving a car and closing your eyes and saying, I'm going to go to KFC. You're never going to get there. You're never going to get there with your eyes closed. Even if Google is telling you turn left, turn right, you're going to either kill yourself or kill someone else. Investing is pretty much like driving a car. It's best done with your eyes open. Having a definite purpose for investing is going to be it's going to be the massive difference between failure and success. Just like training in a gym, investing can be very difficult. It can become very difficult, tiring, and even dangerous. If you're not working towards a goal and monitoring your progress towards that goal, it's gonna be a hell of a tough ride for you. And you're barely gonna have any motivation. That's funny. Peter says that his car has autopilot towards KFC, so he's fine. So look, I just want to ask you all, just a couple of you, a question. If you all like to answer, I'd love to hear. If you don't want to answer, that's absolutely fine. But if you'd like to share, I'm sure we'd all like to hear what your definite purpose right now for trading is. Your goals might change, your goals will change, your vision of things will change, your motivation will change. Just like entrepreneurship, when Google started out, they were a totally different company. Right now, they're totally something else. They never knew they would get there. So was Facebook, so was Tesla, so was so many different big companies and small started out with different purposes. I mean, even you guys, you all came to this industry for different reasons, and slowly, what you're listening to, what you're finding interest in, is becoming different. So, do any of you have any kind of goals right now? Well, Peter has an excellent one, to become consistent at making a monthly wage to live better. David, that's a good one as well, to learn to be a better trader. Economic freedom for my family and myself, and have the resources to help other people. Well, that sounds exactly like what was mine. Well, Michael wants to supplement his current income in his short to medium goal. His long-term goal is to replace his income. I know yours, Craig. I do. Very good. Well, there's plenty of things here, and they're all excellent. They're all really good. You guys just need to remind yourself of these things. Trading can be very distracting. Many times when we sit down in front of the screen, we can get lost in what we're actually looking at and what we actually should be looking at. There is a lot that tells us, even in the past, where price might be going. For example, look at this. Not many people are going to look at just simple things like this. There are, the market's just a beautiful little picture, and it always wants to show us something if we're looking. Sometimes it's not there, sometimes we just can't find things. I've done this on another pair. It's not Euro CF chat. It's probably what's it called? GBP or USD CF chat. But we'll check that later. What I want to just explain to you is that the market is always trying to give us information. It's always there, always there. The information is always there, and there's plenty of it. But here's the deal: when you sit down in front of your screen, you need to know what you're looking for. You're not just looking for your moving averages or vibrational points or somebody to tell you what to do. You need to look at the market, look at the chart, and in a couple of minutes, know what you're going to do. But as well, you have to be ready in a couple of seconds to change your mind about it. What do I mean? I mean this. If you sit down in front of your screen and spend 13 minutes looking at it, you've just wasted 10 minutes. Because you just need about 3 minutes to really look and decide what you want to do. Once you decide what you want to do, you need to take the smallest risk possible, but also a risk that can make you some money that's going to be, important to you. Time is very important here, and sometimes just a couple of minutes can make a very big difference. Now, obviously, these are daily charts, so if we're opening a position on this or we're calling a signal on daily charts, these are long-term signals. This is something, it might kick in 12 hours, in 10 minutes, or in 2 days. For example, this. You see this? I'm going to just show you. Okay, we're going to go to the 50% level on this, just real quick. And I'm going to show you something. You see that the first moving average is not getting broken yet. It's almost broken, but it's not. Come on. I'm misclicking a lot. Okay, so logically, what I would tell you here, and I've already taken this trade, is that I would sell, and I did send this out for a sell. It wasn't a small profit. You see that the first area of interest is just 50 pips away. But that's still decent, 50 pips is 50 pips. Obviously, I like to take much more on trades, but I really think that this will go down if we break the 55 moving average and also the 50% level, the gray one here, where then we're looking at basically a change in trend, because we right now have a medium trend on the upside, right? That's where our trend is going, on the medium side, because this is from November, you see. It started around the 25th of November. Before that, it was just chilling out. Before that, we had a longer term trend downward. So this could just be a correction from this trend before we move down to the next level. So I just want to just see where the 50% level of that is on this trend. Just a moment. So you see, we are right about at that stage right now. You see, we're at the 50% of the high, not really the high. Yeah, well, somewhere there, of the high of this movement here, and then we have the next one, which is going to be going a bit more down. But I really believe the pound is going to be much stronger. So I just want to go into just a couple of rules for everyone here. I want to remind you of our rules, and I'm going to do that very, very quickly. Just two of them. Yes, Richard, I know. That's what I sent in the emails. I don't trade for 50 pips ever. I don't like trading for 50 pips because, it's not much. So that's why when we send signals out, we send you signals they're gonna make you money. So if we send 5 signals out and you lose 4 of them, that one is gonna make you more money than the 4 lost, and you're gonna be happy. This is the essence of trading. Protecting your losses. Basically, when you're wrong, you protect yourself, and when you're right, you make sure you maximize those profits and make as much money as possible. That's what trading is. That's what real investing is. That's how you make money here. You don't make money by winning 95% of your trades. Pam is asking is, yes. It is more of a long-term trade. Now, what I mean by a long-term trade is okay, that's good. Yes, I'm in this one, and my stop loss is quite high as well. But I'll talk about, again, entries and exits a little bit more today. But what I want to tell you all is this, and I've said this before. If we are entering positions, taking 20 pips on them and getting out, or 10 pips, which is even worse, it's insane. We expose ourselves, especially if we don't have stop losses or have very big stop losses and taking small profits. We're exposing ourselves to something that's pretty dangerous. What's good to do is this. Let's say we have a position and let's say we open it over here. Our position goes into a profit and it's over here. Let's say the profit, not that much. Let's say it's here. And let's say you have to leave the house right now. Your stop loss is up here, okay? And you have to leave the house right now. You need to go and do something. What I would recommend you to do is just move this down here, okay? Just a tiny little profit. You're securing yourself. You don't care. You've just protected that trade. It's totally risk-free. There is no risk in trading, in you getting worried about something. So it's very important to protect what you have. You can either close that position, but I would not recommend that because, your stop loss might get hit, 7 out of 10 times, 8 out of 10 times, even 9 out of 10 times. But at one time that it won't get hit, it's going to be, the difference between capping in 50 pips and 2, 3, 4, 500. So, which brings me to portfolio diversification. This is one of the only, it's not the only, but this is one of the rules in the financial markets that can be mathematically proven true. And that's the portfolio diversification rule. In the shortest way I can explain this is that this simply means that you should not put all of your eggs in one basket. And I'm going to bracket the eggs into investment positions. So you should not put all of your investment positions into the same basket. You need to, open in different terms of different currency pairs, different classes of investment, different currencies, and even different economic time zones. And, if you're going to open about 5 positions, what you need to do is not have them be all, let's say, pro-dollar. Because if the dollar becomes weak, you're going to get destroyed on 5 positions. So that's 5 times losses, 5 times sadness, 5 times everything. It's fine to have 2, for example, but it's really not recommendable. What I would recommend to you to do is find different setups. If you do find some setups, let's say you find GBP USD buy, so you're buying the pound versus the dollar, but you're buying the euro versus the pound, because that's what your setups tell you. You need to understand that even correlations change in the financial markets. You see, the euro is becoming more connected to gold right now. Never used to be, but it is right now. There's many other things there that connect, that are changing in the financial markets, and that's just one of them. So, while we're at this portfolio diversification, I just want to remind you again, I'm sorry, but about risk management. There's a quote that, you probably all saw it in your Facebooks or things like that, and that's from Warren Buffett, when he speaks about reputation. He says it takes 20 years to build a reputation and 5 minutes to ruin it. And if you understand this, you will do things differently. So, it could take you months, weeks, a lot of time, okay, to build up your portfolio or save the money that you're going to be investing in the markets. But if you lose that money in about 5, 10, 20 minutes, because that's exactly how long it will take when you make the wrong trade and you move your stop loss a little higher or totally remove it because you hope it's going to turn around, I promise you the day you do that, the trade you do that on, and which is even worse is that if you actually make money on it, because that's going to put something in your mind that you actually made money on it. Nobody has ever been successful. I'm telling you, no one. If somebody's telling you that, they're either lying or they just haven't traded enough to get destroyed. Think about it. No stop loss is something that, it's just a recipe for disaster. Which brings me to rule number 2. Always protect your capital by using a stop loss. For most people, it is far easier to clinch onto hope that a losing trade will turn around than it is to simply get out of a losing trade and admit that that trade did not work out well. Let me make one thing very clear. Getting out of a losing position is absolutely critical. Traders who do not cut their losses will never be successful, especially in the long run. And if anybody's telling you otherwise, they are either not trading a long time, or, again, excuse my language, or they're full of crap. almost all of the examples of trading that got out of control, and I'm talking about on the professional level, hedge funds, banks, almost every single example that I've read in my life or heard of or seen, people that lost, went out of control, went rogue, jeopardized the health of a financial institution, involved people that opened trades that were allowed to develop into large losses because they were not cut short when they were small, manageable. And the big majority of retail losses that I see with my own eyes are due to this. I've seen this with my own eyes. People lose because they allow themselves to take big losses. So being wrong is very acceptable, okay? But staying wrong is totally idiotic. To be wrong is the most natural thing in the financial markets. You need to be wrong. You will be wrong, and if you're not, you need to pinch yourself because you need to wake up and come to the screen, come to your station and start trading. I've said this to a friend of mine today. Amateurs go broke taking large losses, okay, because they just don't know how to manage their portfolios and they have no idea about risk management. So amateurs, they just go broke by taking big losses. Professionals, on the other hand, go broke by taking small profits. It's the same thing. They're the same person. Okay? So if you do not stay with your winners, you're not going to be able to pay for your losers. This is the idea that I'm trying to put into your minds of maximizing your profits. Don't rush to take them. Don't use take profits that much. I actually don't even use a take profit. Only, again, if I'm leaving my station and I know I'm going to be gone for a while, and because I trade on many different accounts, I can't put them all on my telephone, and I really don't want to walk around with my laptops and things like that. So I just put my take profits in, or I move my stop losses into profit, and I just leave them there. Okay, so the most important thing about cutting your losses is to have a predefined point where you will get out even before you get inside the position. This is called trade entry and exit management. This is a part of your capital protection plan. But we're going to speak about this tomorrow more. So if the market moves to your price, basically where your stop loss is, it will take you out. No excuses, no exceptions. This rule, just like every other, must be followed, because when you have a stop loss, your stop loss doesn't care how you feel. Your stop loss will not make excuses and say, well, I think the market's going to move around, or not again, let's just go a little higher and we'll be fine. Your stop loss doesn't care how you feel and what you think. It has no exceptions and no excuses. Your stop loss follows rules, follows every single rule in the book, and that stop loss will always close you out. If you ignore this method, or if you don't follow it all the time, 100% of the time in fact, this will eventually turn out into a disaster for you. So there are 3 types of trades. Going into something a bit more different right now, so I'm still speaking about risk management, but just a little bit different. There are 3 types of trades. One is the conservative trade, there is a medium trade, and an aggressive trade. And you should have this clearly defined in your mind. If you have a $10,000 account running, you need to know exactly what the conservative trade to you is, percentage-wise, risk, what the medium, and what an aggressive one is. You can obviously add your own risks. You can totally make it your own. But I strongly recommend that the aggressive one does not exceed 2%. Okay? The aggressive one cannot exceed 2%. I explained to you guys before. I'm sure you remember. I'm sure you remember when I was giving you examples of those free traders. When I said, somebody risking 5%, all they have to do is lose, 10 times, and they're doomed. So, and here's the moral for our lesson today. Create your own entry. Okay, this is for the entry. Trade types. So conservative, let's put it at 0.5%. Medium, 1%. These are maximums. And aggressive, 1.5%. Okay, and that's the most you will ever open. on these trades. And if you have a trading journal or something like this where you document a little bit more of what you're doing, you can actually write down which trades are where, how many you opened here, how many you opened there. Once you do that, at the end of the month, you will understand a little bit more about yourself. And understanding a little bit more about yourself is pretty much the essence of trading. And I'm going to come to this right now. So, if you want to become a trader, then you must actually start trading. There is really no substitute better than this one. There is nothing that I can tell you that will make you a better trader than actually starting to trade. Because when you start to trade for real and you make mistakes, those mistakes will actually count for something. And believe me, I'm going to make this clear. You need to make mistakes. Mistakes and making mistakes is a part of becoming a real trader. If you do not start trading with real money, I'm not telling you to make an investment with me or anywhere else. I'm just telling you, if you do not start trading with real money, and by this I mean enough money, listen to me carefully, enough money that it affects you when you lose or win, you will not learn a single lesson of trading. Now, one of the best reasons I can associate what I'm saying to this is the fact that you will actually start to protect your capital more, and you will start to take things more seriously. You will listen to me more, because when we're trading on a demo account or paper trading and we lose, don't really take any lesson from that. We just kind of brush it off, open a new demo account or rip that paper apart and say, I'll start from the beginning. Now, at the same time, it is very important to get through understanding the fundamentals of trading. Now, when you're armed with this kind of knowledge, you are going to make fewer mistakes, and you will learn much more quickly from your mistakes, from the mistakes that you make. Lisa, it's normal. Lisa says that if making mistakes makes me a better trader, then I'm approaching mastery. The point is to actually start learning a lot from those mistakes. Lisa, if you think that you're making many mistakes, I really need you to do something for me. And if you do this for me, I promise you I can really turn you into something amazing. If you can just write down every time you make a mistake, but don't leave it for later. Forget about the markets. You close out, you don't put a stop loss. I want you to write down that. Whatever your mistakes are, let's say you don't put stop losses. I want you to get a pen and a paper and write didn't put stop loss. And then I want you to put 1, 2, 3, 4. Just keep adding their numbers or ticks or lines every time you make that mistake. Then at the end of the trading week, I want you to come to me, send me an email, send me a picture, and tell me, Dennis, this is what I've done. This is where I messed up. How can you help? And then I promise you I will find a way to help you. I've done this before with others who are not as bright as you. Okay, you're very bright. You're probably brighter than me. You have much more experience under your belt as well. So obviously you made many mistakes, but that's totally fine. Believe me, you don't understand how many mistakes I've made. If I was a weaker person, believe me, I'd be sitting with a bottle every time. Many people do that, and I'm telling you, I made a ton of mistakes. But then one thing changed inside me, and I decided, and I said, it's time to stop making these mistakes. But I didn't just do it verbally, I did it with actions. So I have a plan. Thank you. Thank you for trusting me with that and do that. So Kieran has a very good question. He says, what about when you start compounding on the aggressive trading and it becomes more than 2%? Okay, so when we're compounding is really, really, when we're increasing the risk, can be pretty hard to do correctly. But I'm going to show it to you like this. There's 10.5. Just a second. Let me just pull out the calculator and just do it for you live so you can see what I'm going to show you. So 10.5, and we start with 2%. So okay, this probably good. So half a lot would be good here. Okay. We start with this, okay, in 42 pips. You start at 0.5. We need to go down on the second one here. We need to go down on the second one, preferably to 0.3. Okay. So, let's say we catch a trend. We catch something like this. The third trade you would want to open up a little bit, and you can already start going up from the third one, but not to the same level as the first one. Now, you all need to understand this as well. When we open the second trade, the margins are already fine. We're totally fine. We're not risking anymore. So because this is in profit, and this one, I just can't put it here. Okay, this doesn't look. So this goes in profit. This one is making a small loss, but together they're making a profit. Once we open the third, it's the same thing. So it doesn't really matter, just as long as your risk is not very aggressive. Already on the third trade, you can even go to 0.6 and you'll be fine. And then you can even start increasing it by 0.2. Okay? You can start increasing it by 0.2. You're going to be totally fine. If you look through this mathematically, and we're going to try and do it on something that might be more active, I will show it to you live. But it will not hurt you in any way, believe me. If you start going by even by 0.25% higher, then you're gonna totally be fine. Well, we need to have the stop losses in. Kiri is asking what happens when you go to bed and it turns around. The stop losses always must be moved. We can't leave any trades open without. We would not open the second, third, fourth, fifth trade if we do not put those those stop losses into a profit. Do you follow? Okay, what do you mean they turned around? They hit your stop losses and all your positions close out, right? But logically, by doing it correctly, you should be making a profit. Don't, if you're using, are you using stop losses or a trailing stop? And what happened? You lost money? Okay. Your first trade was 20 pips in profit, then you open the second trade. But how are they both in negative? You're supposed to do this. Let's say this is our trade, and I'm gonna just put this. I'm just gonna do this very quickly and put this at 20 pips in profit. Okay. Just think of this. Think of this. Think of this as the place where we open. I'm just putting this so we can put the second trade. So, second trade comes in, okay, and we move. Let me just grab the take profit. Okay, then you're gonna do this. Let's say at 9 pips, and you're gonna move this there. So look, if this closes out, it's losing 78.16 cents. If this closes in, we're winning 132. And then if we open the third one, which can be the same level. Let me just check how much this is. So this is the second position right now is 15 pips in profit. You can put the take profit on this one just 4.7 pips. This one 24, and the stop loss right there. So this one is losing 112, this one is winning 228, and this one's winning 40. Is this how you're doing it? Yeah, that's correct, Craig. Because even if we do them smaller, even if we open at 15 pips in profit, the reason the second position is going smaller is because the take profit, for example, look at this. This one, they can be at the same place. They can be 10 pips, 10 pips. Stop loss, 10 pips, 10 pips. One in profit, one in loss. But the fact that the first position is bigger than the second one, we're at least breaking a small profit. So even if I open, look at this. So even if I open one lot here, or even 1.5, I think will be fine. Even if I open 1.5 lots here, which is the second position being, the third position being just 14 pips in profit. So I just have to put the take profit on this one, 6 pips, okay? I can move this one here. I can even put it here, like 14. Okay, let's do it like that. So I just want to show you very quickly. But I have to use the take profit because it won't let me. So look at this. The 1.5 is losing 200. This one's winning 400, this one's winning 150, and this one's winning 48. I can even move this lower, you understand? So it's very important to do it that way. So because look, I can now open 2 lots on this one here, have my stop loss at 15 pips or even more, 30 pips, and you see I'm killing myself a little bit with my profits. I'm really drastically taking away my profits, but I'm actually making money because this one's losing 830, this one's making 640, this one's making 300, this one's making 240, and this one's making 170. Are you following, Kiri? Okay, we will, but live examples would show as well better. But you all seen what I'm trying to show you here, that you can even go from 0.8 and eventually go to 2. You can even go to something like 4 on the other one. It will be a bit hard with your, for example, there is a breakout here. So this is third. So you see, you can go here, and then you're actually making a killing now. Because this first position is winning you 1,000, more than 1,000. You see, so this was barely losing 1,000. So everything else is clean profit. And this is 4 lots here. So if you go, like, look, just for you guys to understand, the power of this when you catch a trend, and why am I adding moving average for you for this. But like I said, you see, I'm going to make something clear. I am going left, right, and center a little bit. This is how I work best, because I studied psychology for a very long time, and this is what works best for me, and this is how I train people a lot. These things will change a lot, because what I'm starting is something incredible, and I've been working very hard on it. What I'm doing right now, it's going to be explained so much better and in so much more detail, and it's going to be, well, let's just leave it as a surprise for them. But I've showed you this before, but I just want to show you in this example here. 1, 2, 3, 4, 5, 6. We're at 6 trades, okay? And we're cleaning let's say that these two break each other, because anyway, this one's making 1,100, this one's losing 900. So we're making 200 here. Here, we just have to remove these stop losses, one sec. On this one, we're clearing about, let's say about 600, okay? On this one, we're clearing another 700. Just remove the stop losses. Here. Okay? So you guys can see that we're actually clearing well over $2,000 from 1, 2, 3, 4, 5, 6 positions, even though we didn't even open another one here. So you probably won't have the margin to open something bigger after that, but if you did have the margin, you see I'm increasing by 2 lots now. Oh, went to buy. Okay, I'm increasing by 2 lots now. So if I put the stop loss here, you see that's 15 pips. I'm moving my take profit here. That's 400. That's another 1,000. That's another 1.5 thousand. That's another 900 or almost 1,000. That's 1.3 thousand. See the amount of money you're making? It's enormous. But you need to learn how to catch this. You cannot risk so much with this. And the fact that I'm showing you something bigger, I didn't want to show you like this because I don't want anybody trying something like this yet. I know, Peter, but I'm just doing it really quickly like this, just to give an example. But you guys see the power of this, and I've shown this to you live. Many of you have seen this before as well. You could, Craig. You could do that, but I'd recommend all of you waiting until tomorrow, because tomorrow we will be opening. It's going to be the European session. I don't like opening positions outside of the European session, but we're gonna be opening these positions tomorrow. The good thing is everything will be recorded, so you guys will see everything properly. But I will try and find some trades for you today. So, like I said, if you want to become a trader, you must obviously start trading. Before we go into anything further, I just want to quickly go into 3 little things that I can recommend you all to study on your own if you have the time. If you don't have the time, on the other hand, then let me teach you. Money management. This is the most important part of trading because it controls your risks. And it controls your risk in a manner that will allow you to continue trading through the inevitable bad periods. And this is probably one of the most important things that you can learn and follow. Money management. Market research. Understanding what's important and what's not is also one of the essential parts of trading. For a very simple example, the NFP comes out worse than expected, but the dollar keeps gaining strength. Question mark. You know, many people, I've heard this so many times, they're like, what the hell is going on? The news was bad. I took a sell. Why is it going up? Why is it going up? Oh, the markets are rigged. Oh, blah, 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 blah. They're not. The US economy, just people don't understand. They look at Forex Factory and they see red and they think it's bad. It's not. Even if the figures tomorrow from the NFP come out 157,000, the US job market still grows because it's above 156 right now. So even if it drops that bad, people will think it's really bad, but there is a good chance it's going to fly up. If you have, I need to teach you this, and I will, but having a way to read the market in minutes, to look at what's important and create literally an entry and exit plan quickly but professionally is just as important the beat as the heartbeat is to the heart. It's everything. And the final thing I want to recommend for you all to understand is trading psychology. Understanding yourself and your own personality as it relates to trading is critical. Guys, this journey is much more about making a sincere and open-minded attempt to understanding your own psychology than it is to finding a magic indicator or some book that will give you all the answers, or some fool who's going to sit there and tell you he's making millions of dollars a week or a month and blah, blah, blah. This is just a fair warning to you all. There are a lot of people out there who will try and sell you, or they already have, themselves, their systems, and their advice as bunny ears experts. Don't blindly accept me or anything else. And don't believe the advice of any self-proclaimed expert. The best advice comes from those who are not selling it to you and who are making their money from trading. Learning to become a good trader and eventually an excellent trader, believe me, is very possible. But also believe me when I say this, it requires a lot of hard work and a healthy dose of skepticism. For everyone who has chosen this path, and you all have, regularly, I know you have, and I've told you many times so far, and I will tell you once again, this journey will never end. Those of you who continue to be successful, I promise you, you will never reach the destination you want to reach, but you will achieve a hell of a lot of financial and personal goals. But what's best about all of this is you will learn to find enormous joy in this journey, in itself. And I just want to tell you all that I wish to accompany you on this journey, just like you're accompanying me. Okay, we're gonna, yes, Peter, yes, it does. I'm gonna go into a couple of trades right now and just try and find something for you here. Does anybody have any questions for me before I continue? Well, I don't have them on this chart. I need to use the other computer, and you won't be able to see France 40. But I can send you an email later on. Well, Pat is asking how is the EU connected to gold. Basically, it became a safe haven sometime last year towards that. So every time gold went up, euro gained strength as well. Not only versus the dollar, which would be logical because the dollar is getting weak, gold is going up. Because as you see here, gold is BS the dollar. Okay, so it's gold versus dollar. There is also gold versus euro. And you can clearly see a difference in it as well, because here it just went up by 200 and here it went down by 700. Obviously that's a bit different, but it's only because the Eurozone it's trying to become a safe haven, but you know, it's clearly not. Europe is a mess. So many times last year it was very connected to the moves. So when there was some big news coming out of the EU, especially for example when the Brexit, the thing with Greece was happening, the terrorist attacks, different things, gold followed the euro. The dollar lost strength, euro gained, and gold gained. I will send an email out. And I'm writing this down so I can send an email out. I'm gonna send you an email. These things change all the time, just so you all know. There is ways to use currency and commodity correlations to your advantage. Basically, I'll go into this right now. Professional traders need to understand the sensitivity of this kind of markets. These things are really important, but there are many correlations in the markets, but I also want to tell you that they do change. They change a lot. So I'm gonna send you all an email with the current correlations that we can find in the markets that we know that are connected right now. But I will also send you correlations which were in the past and how they changed. They do change. They don't always follow each other. For example, AUD follows CAD just because they're connected to the commodities. Eventually this might change. Eventually this will change because it has in the past as well. There are many other things there as well, but I'd rather send you all an email than go over it. Kato, do you mean time? Which time throughout the day? Okay, yes. So just a second. Yep, I understand. Yep, okay, I'll send you all. I will send everyone that. So I'm pretty sure you all remember when we were sending things out for the pound. Okay, so personal opinion. I personally do believe that in the coming sessions, we will see GBP USD head higher. Now, I want you all to remember the reason I send you those rules out. There are things in those rules that sometimes tell you, for example, rule number 18. We spoke about this the other day. Be just as willing to sell short as you are to buy long. So if something changes in the market, we have to also change our approach, right? So we can say, let's go buy, let's buy the euro, and that was like last month, and then there's a terrorist attack, and then poof, everything gets destroyed. So we need to be ready for changes. That's called being professional, okay? Because sometimes, again, excuse my language, crap hits the fan, and then it flies everywhere. So we need to be ready for different things. Right now, I said I have reason to believe that the dollar this year is going to get trashed. Cycles are slowly changing, but yet again, it could not happen because sometimes technical analysis is wrong. What I'm trying to tell you here is basically don't think about what the market is going to do. We have, and you have, absolutely no control over that. What I want you to think about is what are you going to do when the market gets there? Now, what do I mean by this? We're looking at this chart here. Price is going up. We know that the 25% level is here. What are we going to do once price gets here? What are we going to do if price breaks here? What are we going to do if price drops back down and comes to the first moving average? Our moving averages have crossed. And as you clearly can see on the daily charts, it doesn't just cross all the time, because when it crosses, it actually moves for some time before crossing again. You see, you will not see it cross here and then cross straight away, right? Here's the closest it's done that, but there was still massive movement. This is not massive movement. But even when it did cross, okay, these are many consecutive days of downs, 2 days up, consecutive days down, 2 days up, 2 days up, well, random noise, and then went back into it. Oh no, keep moving it. 25% level was there. Okay, so basically the moving average is crossed. Now, things can always change. Perhaps price will just drop down and go to the zero level. But this is one of the lowest levels price has come. One of the lowest, I say. Actually, it is the lowest. So, there are good indications that price might continue heading higher. I already am in many buy positions on this. Many of these positions are way in the money, but there's other ones which are not yet in the money. So we as a company are very pro pound. We do believe that it's going to go higher, and yeah, but we're also protected on other sides. So we were trading the yen as well. We did sell it a long time ago. Again, excellent indications of this continuing even lower. What can happen, I'm showing you the Japanese yen, US dollar. What can happen is price to head a bit higher towards the moving average, or as you will notice, we will have a point of interest here, a mathematical point of interest, our 12.5 level. Something's wrong with it. Okay, so I'd rather send this out. I'd rather just send this out because I have been speaking plenty and I have been in many meetings, so my throat is a little tired. I mean, I had a whole bottle of water just now. So I'll just go into questions right now. Do any of you have any questions for me? What would be good for you to ask me is if you have any new trades open, if you follow them, any of our advice, then you can ask me. Richard is asking, are we going to be sending out an NFP email? Yes, we will, tomorrow morning. Michael is asking us about the moving averages. Okay, Michael, the moving averages, the red one, we have 55 periods, okay, but they have to be exponential, okay? Because I will show you that there is a difference between simple, moving average, and exponential. You see? See the blue one? They're both 55, sort of following each other, but most of the times they're not. Plus, I don't like simple things. Okay, so red one, Michael, is 55. White one is 20. And purple is 987. 987. 987. Yeah, Peter. Look, I'm gonna start doing these things more throughout the daytime as well because, Kira, you need to tell me what kind of risk you're taking. But Peter, I'm gonna start doing them much more in the mornings as well because they are more. European trading sessions are the most important in the markets. Kira, I need you to do this. I need you to. I'll tell you now. I will tell you now, Peter. I'm just going on a demo because I have other positions and other things. So, I need you to do this for me. Click on this part here, Kiri, and just tell me when you do this. When you do this and you put 50, for example, if you put 50 pips, how much do you get? Because what I would like you to do, preferably what I would like you to have, is a stop loss underneath the white line over here. So that's about 60 to even 80 pips, maybe in the middle of the red and white one, somewhere there. So is 50 pips 1% to you? The 987. Well, here's a 200 for you. You see, there is a difference. The reason I use a 987 is connected with the cycles of our planets. No, what you're doing wrong is you're in a shorter time frame. All of these what's it called? Moving averages, exponential moving averages, should be used only on the daily chart, because they all take into account, when we're in 4 hours, it's just taking the bars, okay, the candles, okay? They're taking information from these candles. The 987 is basically taking information from the last 987 days. The 55 one is taking the information from the last 55 days, and the 20 from the 20 days. But it will only do this, on the daily chart. If we go to any other chart, we will see a totally different picture. You see? Look where the purple one is here. So we need to go to the daily one. I know many people say that they use the 200. I don't use it. As you see, it doesn't. I just don't use it. I used to use it when I started trading, but I don't use it anymore. I don't use it anymore. Yeah, it's basically a personal thing. I like using this one. I like it when it overlaps, especially on a daily chart. It gives you massive entries. It works as an excellent support, or even resistance. And every time it gets broken, there's always big moves. There's always big moves. Okay, when they cross, these are sometimes. Okay, let's do it like this. So price is heading higher. There's no cross. Let me just find the cross. Okay, here. It's sometimes the best way to start compounding. I told you guys the other day, yesterday actually. So just a moment. Here's our first entry. Let's say everything's going great. Okay. Everything's going great. We have all the indications to start buying, selling, because first of all, we're still not at our level. We're pretty far away from it because this is a daily chart, 50 something pips. You take your first sell. Price breaks the second moving average. And we take our second sell. Okay? We can always take more sells here, but especially when there is a cross, you can start compounding. This is one of the best ways that I can recommend, at least for now, for you to use for compounding. We've broken the level. We went to the next one, where you would kind of want to let your trades breathe a little bit, is at the 50%, at the next 50% level. That's when you would want to open it a little bit. Okay? What I mean by this is, if you open any new positions, your stops, you should let it breathe. Bounce, drop, bounce, drop. Okay? Many times price will just touch that area and go back higher. So what I would want you to do is kind of don't be so active when price is here, but be active when price is breaking. You know what I really wish they did with this software here? I really wish they had, like, you know when you're typing on like one of those social media things, it says that the other person is typing. I really wish I could see that if one of you are typing, because when I ask a question, I don't know if somebody's typing something. So basically, Patty, for now, the best way for me to explain to you this is to use it for buying, you see, buying and compounding. At least 2 or 3 compounds can be done with these crossovers. Correct, Lisa. Correct. Correct. Or you can even start with the first trade at the 20, the second trade at the 50. You're very welcome. You would determine, yes, you would determine a short towards medium trend from these two. You would determine a long-term trend from this one. Everybody needs to understand as well that once price comes close, the reason this is moving and all of them are moving is because it's low in other days. Every time price comes close to the purple one, it always actually comes to it. You will not see price come here and then go away from it. You will see it come and come to it. And just keep watching it. You see, it comes to it. It always comes to it. So this is why I'm telling you that this is going to go up. But Kato, yes, a short-term trend. But to me, short-term trend is not a few hours. It's a few weeks. Short-term. Medium is a few months. Long is years. Did I answer your question, my friend? Okay, good. Yeah, you're very, very welcome. Does anybody have any questions? Did you ask me this above? Did I answer your question, Killer, as well just now? What are you Euro US? Buy? Killer, are you buy on Euro USD? Okay, okay. Well, I also believe that this is going to go up. It's coming close. Okay, well, everyone, look, I'm gonna have to let you all go. It's we're. Well, Kira, let's have a session together so I can explain to you a little bit better of how to use the stops on it as well. Tell me, are you free anytime tomorrow? Weekend, Kira? Craig, man, believe me, I'm really happy to see you here again. My regards to your family, your dad, and everyone else, and I'll see you in tomorrow's session. Yes, Patty. Yes, most definitely. I will call you right after this session because we need to wrap that up as well. Kato would prefer tonight. I didn't see that. Kira, weekend is good. Good. Send me an email, please, and let's arrange it for either Saturday morning time, European time. So let's say afternoon, or or Sunday anytime. Did you get it, Kira? I sent it to you. I sent it to you in a private message. Yeah, 9 a.m. is fine. 9 a.m. is fine. Yes, I'm going to send you that as well. So on this note, I'd like to just thank and congratulate the people that actually joined the Private Investment Club. Richard just reminded me to do this actually. It's really amazing what we are achieving this year, especially this year, because we are breaking a lot of records, and you guys are really in for a treat. There's a lot of things coming our way this year, and the way we're trading is not only to provide you this kind of things on a weekly or monthly basis, but for a very, very long time. And that's coming, and even bigger things are coming, and all it takes is that one trade. With the way we trade and the way we invest, it's just a matter of that one trade. That one trade that's going to turn that 100% into something around the 4, hopefully 5-digit mark of percentage-wise. So that day is coming, and that it will come sooner or later. So thank you all, and really congratulations. Thank you again for coming. It's been an honor talking to you all. Pavi, Kato, I will talk to you both now, and then Kire, I will see you on the weekend. Just shoot me an email, please, with a confirmation when is the best time for you. Everybody else, thank you so much for coming, and I really hope you can all make it for tomorrow. If you can't, it will be recorded, so I will see you there. But thank you a lot for coming.